Preston Parker CPA, accountant in Scottsdale, Arizona, recently shared some thoughts regarding the supplier finance accounting issues. As more companies adopt supply chain finance programs, and even look to such programs to bolster the bottom line, concerns are growing that third-party arrangements could trigger accounting problems. In some supply chain finance programs, an intermediary pays a marketing fee to the company for information about its payables and then approaches the company's suppliers to offer them early payment in return for a discount. As a matter of course, we can offer solutions like this, but we strongly caution our clients to seek clear guidance and approval from their auditors, says Rick Striano, America's product head for trade and financial supply chain for the Global Transaction Banking Unit of Deutsche Bank. The concern is that such an arrangement could prompt the Securities and Exchange Commission to require the company to reclassify its trade payables as short-term bank debt, potentially impacting loan covenants and leverage ratios. Preston Parker CPA also shared practical issues relating the financial supply chain. Costs. As long as the volumes are sufficient, supply chain finance is set up without cost to the buyer. However, costs are paid by sellers, which may include setup fees, structuring costs, regulatory costs where applicable, risk premium for credit risk, operational fees and management time. These costs are generally offset by improved financing terms for suppliers. Bank considerations. Banks providing supply chain finance solutions are concerned with the buyer-related risk. Some of these risks are the jurisdiction in which the buyer is located, how to enforce buyer obligations to pay irrevocably the payments processed through the supply chain finance structure, how to be recognized as a creditor in case of the buyer's insolvency, fraud events, etc. Legal and accounting issues. Companies need to review restrictive covenants in place with their existing banks to ensure that they have the right to enter into supply chain finance transactions. Note that parties involved, buyers, sellers, banks, may have to report under different accounting principles where the requirements may vary. But there's more, according to Preston Parker CPA, accountant in Scottsdale, Arizona, as set out below. In 2005, the Securities and Exchange Commission started an informal investigation into whether aluminum maker Alco properly classified its payments and any discounts received. Several years later, Alco reported that it had heard nothing more from the regulator and considered the case closed. Nevertheless, news of the investigation was splattered across the pages of major papers, publicity that would make any investor relations executive shudder. Major accounting firms, including PricewaterhouseCoopers, Ernst & Young and Deloitte, declined to comment on the issue. The accounting treatment for supply chain finance arrangements became a particular concern to banks, which may act as a company's supply chain finance provider as well as its lender, after Robert Comerford, a former professional accounting fellow in the Securities and Exchange Commission Office of the Chief Accountant, addressed the issue in speeches in 2003 and 2004. Comerford posed several rhetorical questions about supply chain finance arrangements, including whether the financial institution makes any sort of referral or rebate payments to the client, and whether it reduces the amount due from its client so that the payment is less than it otherwise would have paid to the vendor.